Today, we're going to cover a topic of Series A fundraising and what it takes to raise funds, Series A funds in 2025, what you should model, what you should expect, and all things of that sort. So let me start and kick off the screen and the presentation. Just a quick note, I'm not going to be able to see any questions, guys, while I'm sharing. This is a weird limitation of the technology. So there is a questions tab. Feel free to drop any questions in there, and I'll try to get over with the content pretty fast and then answer any of the questions that you guys might have. Awesome. Okay, so in the meantime, I'll start sharing. Okay, hopefully you can all guys see my screen. Perfect. As I said, the topic today is Series A Playbook fundraising, which I call the rules of survival. And the reason I call it the rules of survival is because I think right now, technically only around 20% of companies are able to raise Series A once they raise seed. And if we look at the overall number of startups, that's less than 1% of startups that ever manage to raise Series A funding. So, how do you survive and how do you get into that space where you're one of the very lucky few? So a quick few words about myself. I've been in VC space for 11 years. I saw over 700 different rounds, helped companies raise 3 billion plus, 610 million in 2024. I'm also ex-chief operations officer of Clivel, where we scaled to 8-figure ARR and then exited 2P. Well, not last month now, but last quarter. So kind of went through a lot of the pains you guys are going through in terms of scaling and not scaling and raising money and then eventually exiting the business as well. So what today is going to be about? There is going to be the first portion, which is around your Series A and the state of Series A metrics, which is a lot of different numbers. So bear with me if it's a little bit boring. It's a lot of math, but it's going to be helpful when you get to the round. And then we get to, I think, a little bit more interesting and actionable part around key tips and tricks on raising Series A in 2025, what it takes. We've actually asked over 50 VC funds, and we've got some really, really interesting insights there. So I think that's definitely going to be helpful. And then finally, we're going to look a little bit into the topic of financials and Series A forecasting. What are the key mistakes that people do in their financial models? And then how to make sure that your modeling and numbers align at the Series A stage as well. So Series A fundraising landscape. I usually start with this. Let's just start with a quick history lesson first. So how does the market look like? We went from 2021. 2021 was this amazing stage, which was called growth at all costs. Crazy valuations, best time to raise money. I've known amazing companies that raised 20 and 30 million Series A without having probably like 10K in revenue booked in the SaaS space. Great time. All crashed in 2022. We saw the era of what we call SaaS occur, and VC market crash, very few able to raise. And then the market started recharging a little bit with Gen AI. Valuations began to stabilize. And today, 2025, it's all about efficient growth. It's all about clear proof of product market fit. And it's all about sustainable metrics. What does it mean for Series A companies in practical terms? The deal volume is still down. So yes, companies raise money, but less amount of companies raise money. So you need to really plan carefully to be in those lucky few ones that do end up raising. Valuations are still down versus 2021, although up from a couple of years before. So, I guess it depends how you look at it, glass half full or half empty. The important bit is investor expectations are probably 2x tougher versus what they were just 4 years ago. And there is a much higher threshold for what you're expected to do in order to raise Series A funding. So quick math of global fundraising, just in terms of give you an understanding around what people are raising. So in US, average Series A raise is from 7 to 15 million. Post-money valuations are around 35 to 75 million. Median is at around 45 pre-money. And US has the highest bar in traction, especially gross. So you really expect it to grow fast and have the biggest revenue milestone execution. Europe, somewhat lower raise amounts, but catching up end of 2024. So the average round is at around 10 million euro, and it's 8 to 15 million range, and then 25 to 40 million pre-money. You would normally see on a normal deal, statistically, based on last year data, 29 to 38% lower valuations. UK is kind of in between US and Europe overall, so it's higher than Europe. It's a little bit still lower than US. And you do have lower bar and traction. So you can get away raising Series A with 20 to 30% lower revenue milestones, or being 20 to 30% earlier on the revenue curve, however you want to look at it. And much more focus is on efficiency and your path to profitability. Global expectations in terms of traction depend massively on local markets, but it's 2 to 10 million average, excluding outliers rounds, and it's 10 to 20 million valuation. So again, it varies a lot on the country and sector. We can dive a little bit into this if you have specific questions, but you can definitely expect much lower rounds and also often lower traction expectations. What does it mean in terms of sectors? So this is the data based on US. If you want to take Europe data, you can kind of calibrate in terms of valuation and cash raise, but sector-wise, it's quite similar. So you can see the hottest sectors, which remains, SaaS, non-AI, and AI in the technology space. You could see that AI technology companies raise more money. They raise an average 15 million in Series A round. They have higher valuations, but there are still more deals in the SaaS non-AI space. That's closely followed by biotech and health tech that remain quite popular. And then we have fintech, renewables, which covers everything also related to climate tech, which remains a new hot category. And then on the other side of the spectrum, you see loads of sectors that are less popular with investors. So ed tech is one, another ed tech is another one. Media marketplaces are not too popular. It doesn't mean you can't raise in those spaces, but it's a little bit more challenging, and we'll cover when and how you can increase your chances. So let's dive into what we see investors expect from Series A startups today. So we asked, I think it was around 52 Series A funds, what it takes to raise funding in 2025. Every fund has different metrics. Every fund looks at different things. Everyone values quality of the team, etc. But broadly, where are the median metrics aligned? So number one is, contrary to what it has been before, right now, Series A is mostly raised when you've already proven a little bit your go-to-market fit. So it used to be you prove a product market fit, and then in order to scale and prove your scalable unit economics, you would raise Series A funding. In the current environment, it's not always sufficient. So you need to prove your product market fit, and then you need to prove that you're able to not just show customer love, but actually scale the product market fit and get to customers in a very measurable, scalable, codified way. And then you raise Series A for further growth. So the Series A threshold could kind of move forward a little bit. And what it means for your Series A round and when you expect to raise, you need to show growth, you need to show customer love, and you need to show efficiency. So growth can be anything like revenue growth, customer growth. For pre-revenue companies, it's actually speed of execution and milestones. So it would be partnerships, LOI signed. It can be technical progress on milestones for defense tech or hardware or renewable companies. On customer love, it's about retention. It's about logos, testimonials, usage, engagement. Again, for pre-revenue companies, it would be product validation from partners and distributors. And then on the efficiency side, pretty universal, it's burn multiple, which measures how efficient you are in terms of spending your cash. And then it can be also LTV CAC payback, generally just scalable operations. On top of all of that, you're also expected to show that you're getting to a repeatable sales model and you have an A-class team. That I think is to be expected. So Some quotes from VCs, you don't have to read them all, but essentially what they're saying, number one, it's about a rate of change and growth trajectory. So a startup that's growing 300% year on year with 1 or 2 million in revenue is always going to be more compelling than a startup that has 5 million in revenue but is growing 20% year on year. So you need to think early about your growth, and you need to think about how will you engineer growth before your Series A round. The second bit that's important, it's not just about growth, but it's a texture of numbers. So is the revenue coming from high quality, repeatable customers, or is it one-off deals? Obviously, one-off deals, not ideal. So it's about telling a compelling story with that data and not just presenting one figure. The third one is the speed of execution, right? Like how much time did it take you to get to the first million of revenue? And out of these 50 funds we spoke to, probably at least 3 to 5 would not invest if you've been at the market for more than 2 years in the tech space. This is very different for biotech. This is very obviously different for R&D heavy sectors. But that being said, speed of execution around how fast were you able to get to your milestones matters. And the sweet spot for all remains high growth companies that can become profitable in a foreseeable time. So there's that flight to quality. People want to have high growth plus strong efficiency, and those are the companies that have the best time in the market raising right now. So Series A 2025 metrics. This is specific to B2B SaaS. We're going to get to other sectors. The most notable change is that in 2024, median ARR for B2B SaaS has been at 3 million. And that's up from 1 million in 2021. So essentially just in 3 years, we have tripled the expectation of the revenue that you would have at the Series A threshold. Does it mean you can raise Series A with lower revenue milestones? Of course, loads of companies are doing that every day, but it might be tough. If the benchmark is at around 3 million, you either need to be in a different sector where revenue is not expected, or you need to exhibit very strong momentum, or you need to have an exceptional team, etc. Growth, at least 2x year on year, very often, with really good revenue retention, and we mean 90% plus, 120% plus net revenue retention. Your burn multiple is exceptionally important now. I think I've seen a couple of years back companies with a burn multiple of higher than 3 still raising. Right now, it's less than 1. And I also understand if you don't know some of these metrics, so feel free to screenshot the screen or note them down, because if you don't know them, you absolutely need to learn them by the time you raise Series A. Investors are going to ask about them. And then LTV CAC, I think it's not just 3x. 3x these days is kind of just like A-okay. So 3 to 5x is what's expected. And then great metrics would be 5x plus. On top of that, you also need to show ideally fast sales cycles, quick payback, annual and multi-year contracts, so no one like months to months rolling. If you're building up to your Series A now, think about those things now, because you can still affect them. If your Series A is, let's say, 12 months away, 6 months away, you can change your contracts from monthly to multi-year. You can think about your rule of 40. You can think about, your ACV and things of that sort. That's the time where you can still change your operational strategy and make sure that, if it makes sense, of course, that it aligns with investor expectations. Okay, so how do these metrics and expectations look in other sectors? Now, I've put a bunch of sectors down. I don't know, guys, who everyone, which sectors are you from? I've checked a couple of participants. I've tried to put down those sectors down. So I'm not going to spend a lot of time on it. Again, feel free to screenshot. And then in the questions time, we can come back to later and dive it a little bit deeper. But aside from the overall technology space, which broadly, if you are in a tech space, if you are in, let's say, not B2B SaaS specifically, but you are in a climate tech that's targeting big clients with software, these metrics still apply. If you are in a defense tech and you're selling software to governments or B2B clients, broadly, these metrics still align. Now, if you're in a completely different sector, this is what we're looking at. So if you're in a direct-to-consumer, e-commerce, revenue threshold is even higher. So it's 5 million plus, usually 2 million minimum, and it can go up to 15 million. You need strong monthly revenue growth. So 20 to 25% months and months is a norm. You need very good gross margins. You need a lot of evidence of customer coming back and buying. And that means you really need to look into your LTV CAC. A lot of direct-to-consumer companies in retail don't calculate LTV to CAC because they believe that's a software metric. It's not. You need to look into that and you need to make sure it looks healthy. On the marketplaces side, investors are going to look at your GMV growth. Again, it's ideally 3x year on year. Overall GMV being 5 to 20 million range. Revenue run rate would be 2 to 5 million. Higher growing take rate, at least 50% gross margin, evidence of customer growth, and evidence of network effect. Super important. People don't like marketplaces because historically marketplaces have been very difficult and expensive to launch. So you need to show that you really got some flywheel or network effect and your marketplaces is flying off, and then when it's going to be interesting to investors, and path to profitability on unit economics. Social and consumer apps, or B2C SaaS, is going to depend on the business model. So if you're in a freemium business, you'd normally be looking at 400 to 600K active users, growing 20 to 40% months on months, and some early revenue, probably at least 150K monthly revenue. On a completely free apps, you'd be looking at 500,000 to 2.5 million users. It can be daily active or monthly active, depending on your business model or on the sector. Again, growing 50 to 30% months and months, and then early signs of monetization. For both, strong retention is going to be super critical. So that's at least 40 to 50% in months 1 and 30 to 50% in months 3. And then reasonable CAC, less than $3 for freemium, 0.2 cents on average for completely free solutions. Again, network effect, super important, and good burn multiple. Now, this has a lot of text. I'm not going to go in there too deep, but essentially biotech, climate tech, defense tech all follow very similar patterns. For anything that's software related, that's already generating revenue, you just look back to our B2B SaaS metrics. They're pretty much the same. For biotech, traction is measured in data, in patents, regulatory process. So you need to show scientific and clinical milestones, evidence of significant R&D progress, and a plan through clinical trials, eventual approval. So really benchmarks are about de-risking the science. We can talk about it more if we have any biotech startups on the call. In climate tech, again, software is kind of clear. I think for hard tech or energy startups, it's prototypes and pilot deployment. So you'd be expected to have a working proof of concept. You'd be expected to have a pilot agreement with a manufacturer or energy provider. Ideally, either early revenue or very strong proven revenue pipeline. So very clear market demand plus impact metrics. On the defense tech side, very similar to climate tech side, but here, differentiated tech and early customer validation means more than just ARR numbers. So 1 million in high quality defense contracts is going to outweigh 3 million of generic sales. Capital efficiency is key. Burn ratio is key. Hard validation from government customers is usually the most important traction metric. Pilot trials, partnerships with defense organizations or primes, and then also technology readiness level. So that's a yardstick for product maturity. So it's around 5 to 6 or higher. And again, we can dive in a little bit if people have questions there. Deep tech, AI, hardware generally. I mean, it's right now, I think what we see is that you should have a deployed model or an API. So I know that in the deep tech space, we work with a lot of companies before that managed to raise 50 million and more Series A rounds based on a pure research talent and a very promising model. But given how cautious investors are becoming around AI hype, I think 2025 Q1, we're seeing more and more people asking working product with real world performance data. It can be a POC, but it needs to be deployed. Otherwise, raising is exceptionally difficult. And then for hardware and robotics space, again, it's very similar to what we discussed for defense tech or client tech hardware. Prototype, early customers, trial deployments, and we're seeing deals in which not only LOIs, signed LOIs are important, but it's even a step down. Like people want to see actually signed contracts if it's not revenue generating yet. Okay, what to do if your metrics are off? I think a lot of people are in that space. Number one, lean into one North Star metric. So if it's loved by customers, lean into that. If it's gross, lean into that. And then explain how you're going to fix the rest and build a beautiful story around it. Remember, there are always outliers. So even if you're completely off of the numbers, we work with, again, companies who raise 20 and 50 million without having any of those specific metrics. So for example, in US, just last quarter, we've seen a 60 million Series A raise from a very small team that didn't even have a working prototype. And the reason they were able to secure the round is because they had direct LOIs from insurers that essentially said that the moment the POC is ready, they're going to roll out the product to multiple hospitals. And that's a software product for diabetes patients, but those LOIs were enough to secure 60 million Series A without having some of the metrics. So again, it's possible. And relationships can trump numbers. So sometimes the numbers are not there, but you've built great relationship with VCs. They feel you're a good team and they're ready to finance you. I think the third and most important one, not every business is ready to be a VC-backed business, and not every business needs to be a VC-backed business. There are more financing opportunities there ever. You can raise another, angel or seed round. You can look into VC debt. You can look into customer financing. A lot of people we work with actually turn to customer financing because customers essentially understand your product really well. It gives you relationship with someone who can potentially buy the company further down the road. They're less strict on metrics. They care more about the product. So customer financing can be a very interesting angle where to look for money. Same with corporate VC funds. Everything you need at this stage is get the capital you need to get to metrics. So remember that. Top reasons why VC said no. Very much in line with what we just looked at, but number one is insufficient revenue growth. Number two is poor unit economics. Number three is high burn rates. And then failure to meet milestones. Essentially, the top four reasons is around your execution on the metrics. It's about the revenue or about your efficiency. Weak management team can be another one, or scalability issues, but this just highlights again why it's so important to start thinking about all of those things immediately as you raise your seed funding, and sometimes even before, rather than waiting for people to tell you about it and then you start fixing it and it's probably too late. Other qualitative things that we hear often in 2025 when it comes to rejections is not mission critical. Very often in the ad tech space right now, people just don't believe that anything related to marketing tech technology or advertising tech technology is necessarily mission critical. And a lot of companies, even with a good metrics, get declined. So in this case, you need to show with testimonials, with your retention, that your product actually is mission critical. Defendability is a massive concern right now. Because of the AI, it is so easy to replicate things really fast. So you need to think early on about what your thesis around defendability is. And it's very rarely patents or IP as it used to be. And today it's much more about your network, your community, your execution, your customers, really. Crowded space. Quite often, I think we've seen 2 deals turn it down in AI SDR space just because there are too many companies there. Verticals that have customer churn baked in. A lot of VCs don't want to deal with solutions for gyms, with solutions for restaurants, because those are sectors in which companies go out of business very fast, and hence churn is kind of inevitable. Unreasonable round size and valuations, crowded cap tables. And then sometimes it's actually founder energy. I feel like that's the easiest thing we can fix. That's super, super easy. Founder energy, right? It just, when you come on the call and you show investors you're really obsessed. Sometimes that even helps with, bad metrics, because if you have loads of energy and if you're super obsessed about solving a particular problem, it helps massively. Red flags in real life: no real customers, no path to profitability. These days, the expectation is not just 10x better product, but 100x better. A CEO who can't attract great talent, no skin in the game, no clear distribution strategy, again, kind of no communication around GTM, and again, kind of no ownership mentality. So kind of right now, when you say, I need to hire someone to do this, I think that's very often a red flag, because people want to find founders who are able to take on things and build them out, even if they don't have all of the pieces of the puzzle in place. So metrics and numbers aside and the whole math, the number one most interesting advice that we got from all funds that we didn't hear in 2024 and we didn't hear in 2023 and we didn't hear before is don't wait till you're fundraised to engage with investors. So 90% of all VC investments are generally outbound. You need to put yourself on a VC map way, way before you need money. You can do that either by starting networking much in advance, or what a lot of companies are doing now successfully is building in public. So you build in public, you build a community on LinkedIn or X or whatever, you report on your progress, you report on your metrics, inevitably people are going to see you, they want to come to you, they want to have a conversation. The cold start rounds are becoming super rare. So 2021, you could pitch, you can get a term sheet in weeks from total strangers. And today, 2 out of 3 Series A deals involve investors who already knew the founder for months, at least 6 to 9 months. So you don't want to be on that end of statistics where you count on meeting an investor and then immediately having the synergy and the relationship that they're going to say, you look great, I'm going to invest in you. I think that's, again, kind of universal from everyone. So build investor relationship early. The market is very tight. The competition for deals is huge. A lot of homogeneous products. If you focus on building genuine relationships with investors well before you need money, you have significantly higher chances to attract capital. Why? Because one investor's favorite phrase, we invest in lines, not dots. So they want to see how you perform over time. And they want to see that you're able to execute, you're able to stand on what you're saying, you're able to fulfill your vision, and so on. But also that early connection allows to kind of like role play problem solving together, right? See how the founders are reacting to feedback, see how you think together around certain problems. So start having those conversations early on. How does that playbook really look like in very practical terms? You'd normally make a list of what I called not ICP, right? Not your ideal customer profile, but ideal investor profile VCs. You'd select those that you feel are a great fit. You'd start engaging as soon as you raise seed or whenever you can. You build relationships, you understand the milestones they're looking for in the next round. And then you try to keep in touch with these investors or email or coffee. You update them on your progress every quarter normally. You crush milestones, hopefully with a few months runway left. And then you tell the investors you build that relationship with that you're going to run the process soon and you want to give them the first look. And then you swim in the term sheets, ideally. Whether that's true or not, you never know, but it does increase your chances drastically. Like in the current environment, probably the number one thing you should start doing tomorrow if you plan to raise Series A funding in 2025 or even 2026. Number 2 takeaway is self-engineering the fear of missing out, aka unstoppable momentum. And here a massive change also took place. So how FOMO looked back in 2021, you'd come to an investor, you'd say, we have many term sheets, someone is just, big fund is coming along the way, this deal is going to be gone in 24 hours, and no one's going to buy this now. So if you're going to say it, probably investors going to look at you like you're a madman. The fear of missing out in 2025 looks very, very different. It's around the momentum you build in signing new customers. It's around the momentum in shipping product features, your sales pipeline accelerating, accounts being expanded, so people coming for more. It means that at Series A, you need to invest time to be able to answer questions around what's your LTV CAC, what's your sales cycle, what's your pipeline deal stages. It's not about having perfect numbers. It's really about showing consistent progress through the fundraise process that is not always measured in revenue, but can be measured in sales pipeline, can be measured in conversions, can be mentioned in new partnerships, deal signs, just building that momentum naturally. Magic is going to happen where every new investor call has new updates. That's your goal, right? And again, you can self-engineer that. You can plan that out. If your fundraise, it's let's say a month, and you expect to have 2 to 3 calls with each investor, you can think in advance what kind of metrics, what kind of additional proof points would you build to each of those calls to build that momentum. That means the story gets stronger each week. So that fear of missing out, it becomes natural, because every time they hear you, they say, wow, these guys are great. They've signed another big customer. They've, locked another government contract. They brought someone amazing on the team. Think about it early on. Important advice number 3, don't overemphasize AI if it's not central to your value prop. So 100% of the pitches I probably see now has the word AI powered. And I think we're kind of in a situation which were similar to in 2023 when people talked a lot about Web3 or 2021, 22, where everything was around blockchain. It becomes a little bit too much. It becomes that a generic AI-powered claim can actually hurt your chances to raise. So it's true that AI-led, or mostly like AI-native SaaS companies are raising at probably 40 to 60% higher valuations often, but only if AI is a defendable moat. So AI-powered without substance is going to disqualify you pretty fast. You need to think in advance about that AI story. It's either around AI tech, maybe it's around just leveraging AI tailwinds in the go-to-market. What people still like, everything related to proprietary data that improves over time. I know people are skeptical how much of the data can be proprietary, but I think that bit still works. Automation that compounds customer value. If you're able to say, our AI delivers 5 times faster results. Our AI delivers, 3x cheaper things. And then AI is a fundamental differentiator versus just a feature that you've added on top. So, essentially something that is built into the product from the very beginning versus you've added AI scribe or something related to just a GPT wrapper. So the red flags today is, again, generic AI powered when you don't explain how AI actually works or why it's amazing. And also relying solely of OpenAI APIs with no unique data advantage. I think ChatGPT wrappers still raise money, and obviously they're growing very fast, but it's also becoming more and more difficult because people start looking at it as sugar money. It's like a sugar crush. Yes, you're going to increase and get to massive revenue, but then it's all going to crash because there is no long-term moat and defensibility. And that's why this bit is super important. Fundraising advice number 4, everyone speaks about. So number 1 slide or item most commonly missed in Series A decks is your go-to-market blueprint. And that does not include marketing, or that includes marketing, but it's not marketing only. A good thing I hear from a lot of people is first-time founders talk about product, second-time founders talk about distribution. The product in 2025 is becoming commoditized. So distribution strategy is really a key differentiator because it's so easy to build something really fast, even quite complex products. Execution strategy and how you go to market and how you execute on your vision is becoming paramount. And again, that's GTM Playbook in this case is not about marketing. It's about your strategy around how you're going to get to predictable sales, how you're going to get to repeated customers, which channels are you going to use. Ads are becoming less and less popular and they're growing more expensive. Community-led go-to-market strategies, everything that is able to launch that organic flywheel is going to win every time. And it's important not just to talk about it at Series A level, but to actually show it's working. How do you do that? Again, you go back to conversions, you go back to pipeline, you can go back to talking about community flywheels, the rate of organic growth, virality. You can show sales cycle shortening, or you can show CAC efficiency improving. Again, having that plan in place is very, very paramount to securing Series A funding. And then similarly, in a way, right now, execution wins over first mover advantage. So first mover or first movers are more and more challenged in the era where that product commoditization is often and competitive advantage is eroding. So instead, the focus is on improving rapid execution. So Lovable is a great example. These are the guys. I'm not sure if you've seen them. They launch in November. They're adding 2 million ARR now. Not everyone per week. Not everyone can do that, but the rapid execution is critical. Like, how fast are you shipping? How long did it take you to develop product? How long did it take you to get out to the customers? The question everyone asks in 2024 and now is, how fast can you execute? So you need to acknowledge a dynamic market, but you're proving that you're out executing everyone. And that's going to be more valuable than proving that you have a first mover advantage. And then almost final one in terms of tips, but even in rejection, even if you get a no, ask the VCs to stay in touch, send monthly, quarterly updates. That goes back to building the relationship. Don't burn the relationship just because you've heard no. We work with quite a few startups where VCs invested after 5 to 8 progress updates. So you need grit, you need polish, you need a strategy to make the venture world take notice of you. And persistence is one of those things. Final fundraising takeaway, and I think you guys know this, that's a little bit less contrarian. Your story is everything, and it needs to be supported both with history and with your forecast. So obviously, a story in the pitch deck is paramount. A story in your vision is paramount. But it's also about how you present your forecast and how you present your Excel model. And a bad Excel forecast, that's unfortunately, I probably see for 70 to 80% of the companies, just says, we expect to grow to 100 million of revenue in 5 years, and then we're going to hit break even after year 2. And that's just not sufficient, because your story needs to be, we plan to triple by scaling sales team or by scaling marketing efforts, and then we can double because we're going to go into a new vertical. And then you can see how our customer acquisition efficiency improves as brand recognition grows. So the story needs to be there, and it needs to be supported in the financial forecast as well. So in the remaining time, I want to dive in a little bit on what that means and what that looks like. So first of all, your story and numbers change depending on who you are. So there is this there are actually many more companies, right? But traditionally, everyone wanted to become a unicorn. Unicorn, that's something in the middle, right? So you want to show that you're able to reach the 1 billion valuation in 5 to 7 years. And you're building your financial forecast and story to support that. So that's your classical non-AI native businesses. That's your classical, SaaS over the past 10 years. You just need to show defensibility story around how to survive. Today it's a little bit less flashy, but it's still in demand. You focus on those classic software metrics. You would normally triple your revenue, double, and you try to get to around 100 million in revenue by year 5 or 7, show profitability somewhere in between. Now, if you're in that space, then that's still a valid strategy to do. Now, there are 2 more continuums where companies play right now. One is decacorn or hectacorn. So that's a 10 to 100 billion valuation. Typically, that's the new gen native AI businesses that grow super fast. If you're in that space, if you are in the native AI space, then showing 100 million revenue in 7 or 10 years is probably not going to be sufficient. Investors want to show that you're going to be able to grow faster, especially the tier 1 funds. So your forecast needs to be more aggressive, but your traction then needs to be more aggressive as well. So investors would require to see exceptional growth, adoption, really strong execution playbook. And then on another side of the spectrum, you have Cockroach, and it's not bad in any way, but that's essentially a company that's not necessarily ever going to get to 100 million in revenue. It's a company that grows slower, but is profitable earlier on. A lot of European companies were bootstrapped or quite scrappy. They're popular with selected investors. You just need to know if that's an investor that you're going after. So typically an investor that's okay with 50% year-on-year growth or 70% year-on-year growth. And there you need to emphasize business sustainability. So your story kind of changes depending on your sector, depending on your traction to date, and it changes how exactly you should be presenting your numbers. But first and foremost, before going into any meeting, the one thing you need to do is get your historicals and economics into order. So you need to know your business model economics, the LTV CAC, the CAC payback, the burn. You need to be able to answer those questions. And very often it means that you need to clean up your data before going into the round. Because again, you need to know those questions. You also need to know your sales metrics. So stuff like performance by channel, LTV CAC by channel, your sales cycle. If you don't invest in the data infrastructure or data cleanup now, it sounds counterintuitive. It might sound that it's something that you don't necessarily need to do. You're only at seed level. It's too early. But you do. At Series A, people want to see some of those clean metrics. They want to see your narrative around those metrics. So by the time you get to Series A, you want to have a very solid grasp around your 6 or 12-month metric, how they were trailing, what happened, how is the sales cycles performing, how are the numbers changing based on the experiments that you're running, etc. A Series A forecast or model without unique economics is going to be completely useless. So make sure that any forecast you have also shows how you plan to be progressing on those unit economics. Think from the bottom. So I'm going to kind of go further down, and this is one of the forecasts that we got from one of the prop tech companies we work with. This is not going to fly, right? Regardless of how you form it is, if you say our year one target is 5% of the overall volume and then 7.5 and 10, people are going to ask you, well, why 5%? Why not 1%? Why not 20%? And you won't be able to defend it. So anything that's top to bottom forecasting doesn't work. It works, but you would only use it to sanity check the numbers, right? So you'd never say, we just need 1% to get to 100 million of revenue. It can't be the basis of your forecast. The right narrative would be, we will hire 5 sales reps. They can sell 500K per year after ramping up, and that's 2.5 million per year. Now that's, bottom up, and that's what you would normally be expected. So if you have a sales-driven model, how many salespeople are you adding? What is their quota? How many customers will they bring in? If you have a marketing-driven quota, then how are you going to plan to increase traffic? What's the extra influencer reach? What's the extra ad spend? What are the conversion rates? What's our CAC per channel? And then you show the operational drivers behind those revenues. Again, they should be quite clear. Many models would look deeper into customer cohort behavior too. All of that needs to be baked into your financial forecast. Ideally, it also shows paths to profitability, because right now investors love disciplined growth. So bootstrapped startups are generally sometimes winning actually bigger valuations if they're bootstrapped plus growing fast. So investors love founders who can get to 2 million ARR with minimal burn. Always benchmark long-term margins. See loads and loads of companies that are projecting 70% EBITDA margins, even though everyone in their sector is barely generating 30%. Think about it early on. You don't want to come off as naive when you pitch this to investors. Ideally, you would show a path to break even within the next round. It's not critical, but people like that. And it always tracks stuff like burn rate multiple and rule of 40 and showcase them in a deck if numbers look good. Make sure you actually double check if the return is there. So don't project numbers conservatively. And then especially on large raises, make sure the logic makes sense. So investors want to return at least 10x on the investment, right? Very often actually, or most commonly, they want this to be that big that it can return the entire value of that fund. So if you're raising a 10 million Series A investment on a 15 million valuation, and you're only showing that you're going to have 10 million in revenue in 3 years, it's clear that you're not growing fast enough to generate returns for the VC fund. So you need to do that back of the napkin exercise, thinking about how investors are going to look at your projections and make sure that the growth is there. And I don't mean that you basically just put down any kind of growth for the sake of it. I only mean that you really think about where it's going to come from. And if you don't know how to grow faster, you go very deeply in analyzing your go-to-market playbook. You go very deeply in looking into your channels, and you think, what can you change or what you should change now to speed up that pace of growth. Think about cash, not P&L, and real life execution. Very funny, I think, looking into the models today, just before this one, I think 80% of the models that we review, we don't see where the cash gap is. So the model is so profitable and the company wants to raise 10 million at Series A, but there is not a 10 million gap. So the story needs to match. If you're raising 10 million, that somewhere in the cash flow, there needs to be a $10 million gap. You need to think about churn. You need to think about working capital. I think you need to think about the fact that the ramp up has to be realistic. So again, very often I see we're going to hire 30 people in 1 month. That's never going to happen. You're like a 10 people company. You won't be able to hire 30 people, and you should not be hiring 30 people in 1 month. Remember that small P&L items can also contribute to very big shifts. So sometimes it looks like you don't need money, but you forgot about hiring cost, recruitment cost, benefits. People never count in yearly salary increases, but your employees want to have them. Somehow people practically never count in bonuses. Again, people want to have them. So those are some of the forgotten categories. And most importantly, I think the fundraising timeline is now longer. So 24 months is the new 18 months. Every VC fund we spoke to reflects on the fact that rounds are taking longer. So it's better to start talking investors with still 9 to 12 months runway left. And yes, it often inconveniently means that you would speak or start building relationship with investors immediately as you raise your seed round. You need to aim to raise at least 24 months of runway. And in some deals, VCs are actually pushing the companies to raise enough for 36 months and getting to that profitability. The mantra is raise before you need to, and raise enough so you might not need to do again. And that's kind of very often a new norm. Keep your model simple, just the simple model, the model hygiene. If investors can't easily trace how you get from assumptions to output, they lose confidence. Just check for formula errors. Don't do hard coding. I think most importantly, or like the biggest issue is when you get a model that's not dynamic. You go into a meeting, an investor asks you, what would happen if our prices were 20% higher? And you're like, let me come back to you in 5 days. That doesn't work, right? You need to be able to quickly change inputs and reflect on them in real time as you're having conversations. Finally, or almost finally, it's about benchmarking. Benchmark. We have more data than ever before. We have ChatGPT, we have amazing databases, we have loads of public companies. Look at industry leaders, look at gross margins, look at EBITDA, look at rate of growth. Challenge your assumptions. Can you really be 30% more profitable than the next player? Why? Can you really grow 2x faster than someone else grew a year ago? Why? Or the other way around, if everyone else has gross margins of 80 to 90%, why are ours 70? You need to be able to explain that story. You need to be able to also challenge both pricing assumptions and some of the largest cost items. So it's great. People often come back to me and they say, we have this amazing chief operating officer and he's going to be based out of India and his salary is only going to be 3K. Well, that's not sustainable. That person is not going to work for that salary for remaining 5 years. You need to challenge assumptions around, can I sell at that price? Can I really pay people this? I think if you're thinking about your revenue forecast, a lot of companies stick to this golden rule of triple, double, right? So for 10 years or so in the software space, everyone, when looking at financial forecast, wanted the revenue to triple, and then double. But the catch is it depends on year one. So very often people start with $500,000 and then they triple, double, and it's not enough. Because going back to rule, whatever it was, I think 4 or 3, it doesn't allow VCs to see enough return. So think about that first milestone. You need to be very confident you're going to get to that revenue next year, because you don't want to be too conservative, but equally you want to make sure that you're actually hitting the target. That's nothing worse than promising investor you're going to get to 5 million and then barely getting to 1. The difficult mass of headcount today, and that just relates to benchmarking, is understanding how many people you actually need to execute. So it used to be very easy 2 years ago, because if you were to look in any cloud solution or any SaaS solution, the average benchmark was, around 250K in revenue per FTE. So when you do your financial forecast, you will look at your revenue, you will look at your headcount, and you could sanity check, are my assumptions correct? Well, that's not true anymore because, we're going towards the era where easily we're seeing 10 million per FTE for AI agents. I think Ben Lang posted about this, right? Cursor got from 0 to 100 million in revenue in 21 months with 20 people. Lovable, 2 months, 15 people. Merkur, 11 labs. On one hand, it means that large teams are no longer a requirement. But on another hand, it kind of makes it very difficult to think about how much personnel you really need to be forecasting. So spend some time there together with the team, thinking about how many people you need to execute. It becomes more critical than ever. In the past, hiring more was a golden standard. You'd hire everyone. You have money now. You'd hire a lot of talent. And actually, surprisingly, quite a few companies, even a few years back, that we work with had challenges raising rounds because they had less than 20 people at Series A. And they were hearing back from investors, there's just not enough talent on the team. We want to see teams 20 plus. You guys are not hiring aggressively enough. You're not going to be able to succeed in this. Right now, large teams are no longer a requirement. They can actually be a liability. People are really questioning, why do you need that many R&D people to execute? Why do you need that many marketing people to execute in the era of AI? So balance it out. I don't say you have to be here because very few companies are. So you don't have to show that you're getting to 100 million with 20 people unless you have very strong reasons to say so, which means, performance over the last 6 or 12 months really shows that you're on that trajectory. And invest some time thinking about how your payroll costs and your growth story is going to look like. The final and most important takeaway is great companies are bought, not sold. So when it comes to fundraising, people love giving money to someone who doesn't need them. You need to build a company so compelling that they chase you, which means the biggest mistake you can make at any given point in time is switch fully to fundraising mode and stop building. Environment right now means traction is everything. It's all about, again, speed of execution, how quickly you're hitting milestones, how quickly you're onboarding customers. It's more challenging than ever. And the biggest mistake one can do is focus on building a pitch deck, focus on building a financial model, focus on fundraising versus building. If you focus on your customers, if you focus on delivering value, if you focus on building amazing product, the metrics are going to follow. And when the metrics follow, investors are going to come knocking on your door, and you're easily going to close rounds in a couple of weeks' time. So back to, great companies are bought and not sold. I think we're almost there on the clock. How can we help? Add me on LinkedIn, having loads of conversations there. Happy to chat to you guys. We haven't launched yet, but our product team is building a fundraising copilot. So has a library of slides from successful fundraisers. It actually has models that successfully raise Series A funding. So you can have a look around how that looks like. And generally, we do a lot of pitch deck and modeling support. So anyone who comes from our network, which I automatically count if you've attended this webinar, you kind of do, we can do a free pitch deck review. We can do a free review of your model, let you know how it stacks up versus models and decks we see that are raising, or help you make it better if you're busy building. Because again, back to the point, focus your time on building. My email is here. Mention you come from webinar because I get loads of those emails, and I'd love to have a conversation. Thank you. May the force be with you in 2025. I hope this has been helpful. I'm happy I'll just stop presenting and I'll figure out how I'll stop presenting. And then So feel free to do so. The recording will be available in case you want to revisit some of the numbers and the math stuff part. Okay. Can you share a few examples of startups that successfully pivoted their approach during their Series A fundraise to better meet investor expectations? I think mostly if you feel that fundraise is not working in 2 to 3 weeks, the most successful companies go back to building. So they raise a bridge round or they turn to alternative financing sources and they focus on improving the metrics. I've also seen a couple of companies that successfully pivoted to, again, customer financing. So they've seen the VC financing route is not working. They went to the customers, they were able to secure not such large rounds, but large enough rounds to successfully raise. So those are some of the, good pivots. How do investors normally benchmark model assumptions? Are there tricks to anticipate their logic? They just see a lot of deals, right? So when you see like hundreds of deals coming at your table, you don't actually need to benchmark because you know what good companies look like versus what bad companies look like. But other tricks to anticipate their logic, I mean, again, the return needs to be there. I think if you look at, ask me, I'm happy, reach out. I'm happy to give you some of the inside information, but looking at the public companies, looking at some of the best kind of startups now, where they're performing in terms of growth, looking at some of those benchmarks. If you're hitting the benchmarks I presented earlier, you're going to be there. It's absolutely fine. Those are kind of the assumptions you need. I think looking deeply into operational assumptions, and it can be as easy as going to ChatGPT deep research and being, what's the average quota per salesperson in our segment? And if you see you're significantly off, then that's something to investigate. What's a typical conversion in our sector? There's a lot of public data in it. So look kind of carefully in different metrics and operational metrics especially, and see which ones are off. And that's probably going to lead you to some of the lag metrics like revenue, churn, etc. Okay, enterprise sans fintech, sales cycles are long, very sticky revenue. How do we communicate that to investors? I think that's actually pretty common, so that's fine. You communicate that it's not about months and month growth, but let's say it's about, quarterly growth, especially if you can communicate that sales cycles are decreasing, that would be perfect. The revenue that's sticky, you put it out there. It's like multi-year contract, 100% retention. You build your story around it. I think you set expectation also very early on. So one thing that helps, for example, is also highlighting, the next available leader in the market, the next solution, and saying, well, these guys are seeing, 10% or 20% churn. We're seeing 0, and we're, signing multi-year contracts. Giving some case studies and examples helps as well. Show a really large contract, show how they expanded, show the texture of that revenue, and that's going to be very helpful as part of the pitch deck story. I know we're off on time. I'm going to continue answering questions. Everyone who needs to jump off, you can guys jump off, of course. And then if you're curious about the questions, feel free to rewatch the recording and see how we're going to end up answering. Does the majority of this apply to seeking out angel and seed investments? What nuances and difference are there? There is much less revenue thresholds for anyone who's seeking angel and seed investment. We've actually had a webinar last month that covered everything related to angel and seed stuff. So if you're not yet in the Series A stage, reach out to me and I'm happy to share the link to the webinar that talks about angel seed rules, benchmarks, etc. So Brenna or anyone else, drop me a message, LinkedIn or email, and I'll happily share that. Okay, we've built an AI component into the product. Can we expect valuation premiums in our case? I think it really depends on whether investors and customers, most importantly, see value in that AI component. So if they do, then yes. If it's reasonably why you can show we built an AI component and our retention improved or our growth improved, there is going to be potentially a valuation premium. If not, and it's just a nice thing to have, then unlikely so, or maybe with investors that are still, hot around the AI hype. Expectations in GovTech for Series A, I think it depends a lot. But if we're talking about software, then it would be very similar to SaaS stuff. So kind of enterprise SaaS was the only difference being people understand that signing governments takes longer, sales cycle takes longer. So normally you need to have at least one contract and you need to have some pipeline. So it's less about months and months growth and more about the, what have you actually secured? Which governments are you working with? How many conversations are you having? Andrew is asking or saying, I'm seeing conflicting advice. Some investors want detailed 5-year projections, while others say anything beyond 24 months is a fiction. I know, it becomes very tiring. What level of forward projection are Series A investors actually using? I think 3 years. So what we normally do, we end up preparing 5 years because for some people it's a requirement. Most importantly, I think for a lot of companies, 24 months don't show return enough. Like they show the direction of the hockey stick, but they don't necessarily show return enough. So let me put it this way. If within 24 to 36 months, you're getting to awesome revenue and you're getting to profitability, then I think that's enough. If within 24 months, the story is not yet too compelling, you're still in the process of transforming your unit economics, you're still in the process of getting to that revenue milestone, you haven't entered new verticals yet, whatever, then show 5 years. And it's going to be less about whether you hit your numbers, and it's going to be more about the logic of those 2 final years and the fact that, look, we're going to be able to get to profitability in year 4 by raising another round. How deeply do Series A investors typically dissect financial models? Are they running their own scenarios or mainly looking at our assumptions? I've seen different VCs. I've seen VCs who would follow up with 3-4 rounds of questions, 30 of them. I'm going to ask you, or I've seen VCs who would send us their models, right? So we'd kind of run our own cohorts and LTV CAC, etc. And then VCs go into due diligence and send us this huge model that shows we're completely off on calculating some of the stuff. And they look at it very differently, etc. So I think it's common for top VCs to run their own models. It's common for anyone who has customer data to share raw customer files, and VCs would run their own cohorts and they would run their own trends. And that's pretty normal. So they would dive quite deep. And in due diligence, they're also going to dive quite deep into stuff like sales data and pipelines if they're good. Have I seen deals happening at Series A stage having like a sheet of nothing? Yes, that happens too. But I think it's better to be prepared for very deep dissection of financial model. Don't think about it. I don't think it's just for the investor, right? It's for yourself. When you dissect that model to that granular level, you're going to uncover things and insights that are super useful in your operational performance. You're going to see sales drivers. You're going to see certain parts of the business not performing. You're going to be able to see a problem. So again, it's not for the investors. I think for yourself, dissect those models. And then whether or not investors dive in, that's their own business. Question from Adam. How do investors rationalize the 40% valuation gap between US, where product and tech innovation are the same? And as U-based AI startup, should we keep our focus solely on US investors? It's a good question, but the valuation difference is only there when, again, the traction difference is there. So you'd see higher valuations because the company in US is growing faster. If you have, a European company that's growing at the same rate, I don't think there's going to be a valuation gap there. So it's kind of around what level of traction you have achieved. Okay, will customers still be confident funding if you failed with VCs? Yes, I've seen this many, many times. First of all, your customers don't know that you failed with VCs, and you should not tell them about this. So that's probably tip number 1. Tip number 2, I think customers understand things much better. And it's not always customers, it's partners. So if you would see, for example, prop tech, right, everything related to real estate tech, construction tech, first round sometimes can be pretty difficult with VCs. Not everyone likes or understands the space. I've actually seen Series A rounds being funded by developers, by construction companies, because they understand the value of software. They don't care how fast you're growing, because they know that in their huge company, if they implement the software, then they're going to see incremental improvement. So for them, it's beneficial to actually get the solution financed. In a similar way, for a lot of financial institutions, they see an opportunity to deploy capital with a much higher yield, for example. So they want to get you financed regardless of whether or not you got VC interest, and that's helpful. Okay. Amen, you mentioned showing numbers that will allow VCs to get to minimum 10x valuation increase. What time frame would you apply to this? I think historically that would be 5 to 7 years. Back in that era of SaaS, good old SaaS. Right now, it's a little bit of wild, wild west. So some people want to get to these returns much, much faster. If they're looking at AI native products, 2 to 3 years. Some people are still okay with longer horizons. I'd say, 5 to 7, but this is probably a good thing to ask a VC you're speaking to as well. I think we are out of questions. I hope this was useful. We'll share the recording later on. Thank you very much for everyone who attended. Looking forward to connecting offline or online off webinar. Thank you for your time. Have a great day, night, and great week ahead. Bye.